Not many traders know about one of the simplest indicators that depicts such well-known candlesticks. This indicator is Heiken Ashi. Heiken Ashi charts are becoming more and more popular among traders, and there are many trading strategies built around this type of charts. These Heiken Ashi candles are a perfect tool for traders who like following trends to their very extent. Heiken Ashi candles also looks much more simplified. Basically, Heiken Ashi charts make candlestick charts more readable for traders who want to know when to stay in a trade and ride a strong trend and when to get out when the trend weakens. Although Heiken Ashi has many advantages, a lot of traders prefer to analyze classic candlestick charts. But what if you could combine both charts in order to have the classic candles and still be able to plot Heiken Ashi candles? We can do that by using smoothed Heiken Ashi candles. In today's video, we'll take a look at the Heiken Ashi smoothed indicator, and I'll show you how you can apply this tool and configure it to your preference. If you want more videos more often, please smash the like button, subscribe, and turn on the notifications bell so that you know exactly when new content is released. Everything we discuss in this video can be used for currency trading, stock trading, and crypto because price action stays relatively consistent across different assets. So we're going to go very in-depth in this video. The main difference between Heiken Ashi charts and traditional candlestick charts is that Heiken Ashi charts the average price moves, creating a smoother appearance, helping traders to identify past price movements more easily. On the other hand, candles on traditional Japanese candlestick charts frequently change their color, which can make them difficult to read. Because the Heiken Ashi price bars are averaged, they don't show the exact open and close prices for a particular time period. You'll notice that Heiken Ashi charts have a tendency for its candles to stay white during an uptrend and stay red during a downtrend. This is in contrast to traditional Japanese candlesticks that alternate color even if the price is moving strongly in one direction. Heiken Ashi chart is much smoother looking in terms of price action, helping traders to identify past price movements more easily. This is why many traders prefer to use the Heiken Ashi candle since it reduces the noise on the chart and allows them to analyze trends more clearly. What makes Heiken Ashi different from a traditional Japanese candlestick chart is how the price is displayed in terms of the open and the close. If you look closely at the Heiken Ashi chart, you'll notice that a bar in the Heiken Ashi candlesticks starts from the middle of the one before it and not where the previous candlestick had closed. While traditional Japanese candlesticks require many definitions and flexible rules for most patterns, a Heiken Ashi chart works with only the 5 simple rules. White candles signify an uptrend. Red candles indicate a downtrend. Longer white candles with no lower shadows indicate a strong uptrend. The downtrend gets stronger with longer red candles and no upper shadows. Let your profits ride. The trend gets weaker with smaller bodies and with the emergence of lower and upper shadows. Candles with a small body surrounded by upper and lower shadows indicate a consolidation or trend change. The trend reversal could follow when you spot multiple candles with small bodies and long upper and lower shadows, doji-like candle, or a sudden color change. Now, what are the limitations of Heiken Ashi? Just like any other indicator used for technical analysis, Heiken Ashi is useful, but it does have some weaknesses or limitations. While the traditional Japanese candlesticks are derived from the actual prices, Heiken Ashi candlesticks are not. Because the Heiken Ashi candlesticks are averaged, they do not show the exact open and close prices for a particular time period. Let's show an actual example. Here's a Heiken Ashi chart of Apple on the daily time frame. Focus on the last candlestick. The candle is red, which means the candle closed lower than it opened. Its open price was 130.00 and its close price was 128.80. Now let's look at a daily chart of Apple using a traditional Japanese candlestick chart. Focus on the last candlestick. A couple of things to notice. The candle is green, which means the candle closed higher than it opened. This is reality. The candle actually ended up for the day. Compare this to Heiken Ashi, where it showed a red candle. Its open price was 128.80. Its close price was 128.97. Do you see the difference? Even though the real candle closed green, Heiken Ashi is signaling that Apple stock is still in a downtrend. Make sure you know what price you're looking at. Heiken Ashi charts obscure actual price information. The closing price is considered important for many traders, but the actual closing price is not displayed on a Heiken Ashi candlestick. But we can fix this problem by using the smoothed Heiken Ashi. The Heiken Ashi smoothed indicator is a modified version of the regular Heiken Ashi candlestick charts. But the main difference between the regular Heiken Ashi indicator and the Heiken Ashi smoothed indicator is that the second type of indicator plots the Heiken Ashi candlesticks as a moving average. And now, as you can see, you'll get a better perspective of the markets. You can see both the regular candlestick or bar chart alongside the Heiken Ashi smoothed indicator. This is not possible if you use the regular Heiken Ashi chart that is offered as a default indicator. Traders have developed various trading strategies built around the Heiken Ashi smoothed indicator. One of the major rules of using this indicator is in determining the trends in the markets. The general rule of thumb is that the markets are in an uptrend when the smoothed Heiken Ashi indicator is bullish or white, and the markets are in a downtrend when the smoothed Heiken Ashi indicator is bearish or red. The Heiken Ashi smoothed is a versatile trading indicator that can be used to build a new trading strategy, or it can also be used to complement your existing trading strategy. It's a trend-following indicator. In uptrends, price tends to stay above the smoothed Heiken Ashi. In downtrends, price typically stays below it. And the first possibility of a change in trend is when price crosses through the indicator. Downtrends start to reverse when prices cross back up and through the smoothed Heiken Ashi, while uptrends show signs of reversal when price falls through the smoothed Heiken Ashi below it. The Heiken Ashi smoothed indicator can be installed as you would install any regular indicator. Once you move the file into your MQL indicators folder, you can refresh your list of indicators so that the trading platform picks up this new indicator. The settings for the smoothed Heiken Ashi indicator are very simple. Depending on your trading style, scalping, day trading or swing trading, you can change the value of the indicator to suit your trading needs. Here are several settings you could try. 5-period smoothed Heiken Ashi. This is suited to scalping techniques, tracking the strong momentum and the trend in the short term. The 5-period smoothed Heiken Ashi acts as support in the strongest trends. This line is best used in low volatility trends with strong momentum. You can also use it as a trailing stop. In this method, after you are in the market with an open position, the stops are adjusted to a few pips above or below the highs and the lows of the Heiken Ashi smoothed indicator. 12-period smoothed Heiken Ashi. 12-period smoothed Heiken Ashi is a great setting to keep you on the right side of the major market trend. It's usually the first line to be lost before any real trouble begins, meaning any reversals in current trend. From my backtesting, this is one of the best smoothed Heiken Ashi indicator settings. It can be used as a standalone signal in some stocks and currency markets that tend to trend strongly in one direction for long periods. 50-period smoothed Heiken Ashi. 50-period smoothed Heiken Ashi acts like an intermediate-term moving average. Again, the 50-period smoothed Heiken Ashi can work as long as you use the indicator on assets with less volatility. As noted, the 50-period smoothed Heiken Ashi is widely used because it works well. Long-term trend traders commonly use the 50-period smoothed Heiken Ashi, whereas intraday stock or forex traders often employ a 50-period smoothed Heiken Ashi on a 1-hour chart. If you enjoy swing trading or position trading, you could use the 200-period smoothed Heiken Ashi, which indicate long-term direction. The 200-period smoothed Heiken Ashi is considered a key indicator by traders and market analysts for determining overall long-term market trends. The 200-period smoothed Heiken Ashi can give traders a sense regarding whether the trend is up or down, while also identifying potential support or resistance areas that usually presents a great risk-reward ratio. Now, how to trade using smoothed Heiken Ashi. The smoothed Heiken Ashi technique is really useful for making candlestick charts more readable, trends can be detected and found a lot more easily, and buying-selling opportunities can be spotted at a glance. When you use smoothed Heiken Ashi properly, this indicator can help you spot trends and trend changes from which you can gain some pips. And now, we will discuss how to use smoothed Heiken Ashi indicators. Let's go through it more in depth. There are 3 main ways in which you can use the smoothed Heiken Ashi to determine the direction of the trend, to determine support and resistance levels, and using multiple smoothed Heiken Ashi for long and short-term market trends. First, Determine the direction of the trend. Trading with the trend is like trading with the flow. When the trend is directed upwards, why would you choose to go against it and seek for short entries, while going long might result in much better trades? When prices are trending higher, the smooth Heiken Ashi will adjust by also moving higher to reflect the increasing prices. This could be explained as a bullish signal, where traders may prefer buying opportunities. The opposite would be true if the price was consistently trading below the smooth Heiken Ashi indicator, where traders would then prefer selling opportunities due to the market signaling a downward trend or bearish. Second, using smooth Heiken Ashi for support and resistance levels. In this chart you can see several examples of how the smooth Heiken Ashi can be used as powerful level of support or resistance. After the resistance level or red smooth Heiken Ashi has been broken, the price continues to go higher, you could enter a long position after the market on a retest of the blue smooth Heiken Ashi. Or after the support level or blue smooth Heiken Ashi has been broken, the price continues to go lower, you could enter a short position after the market on a retest of the red smooth Heiken Ashi. If you see the smooth Heiken Ashi trending higher, you could enter the market on a retest of the smooth Heiken Ashi. Likewise, when you are long in an uptrend market, then the smooth Heiken Ashi can be used as a trailing stop-loss level. The opposite is true for downtrends. Third, using multiple smooth Heiken Ashi for long and short-term market trends. This multiple smooth Heiken Ashi is a technical indicator that identifies changing trends, breakouts, and trading opportunities in the price of an asset by combining two smooth Heiken Ashi with different time periods. This allows traders to simultaneously assess the short and long-term trends in the market. As price crosses above or below these plotted levels on the graph, it can be explained as either strength or weakness for the asset you are trading. This method of using more than one smooth Heiken Ashi can be extremely useful in trending markets. Smooth Heiken Ashi trading strategy. When making use of multiple smooth Heiken Ashi, you might have the idea to trade when the lines will cross. A bullish cross is identified when the short-term smooth Heiken Ashi crosses above the long-term smooth Heiken Ashi, while a bearish cross represents the short-term smooth Heiken Ashi crossing below the long-term smooth Heiken Ashi. This is a wrong approach. It's very dangerous to use smooth Heiken Ashi crossover as main signal of your trading strategy. Heiken Ashi is considered a lagging indicator that not only dismisses useless signals to open the trade, but also provide you with a late signal for closing the trade. Attempting to build a crossover strategy with two smooth Heiken Ashi lines is very bad idea. If you don't want to see the market slowly destroying your profit as the trend you are trying to trade has already changed, I advise you to use multiple smooth Heiken Ashi lines only for dynamic support and resistance levels and not for crossover signals. Smooth Heiken Ashi indicator is perfect for backtesting to see what signals worked in the past because they are grounded in math. When a smooth Heiken Ashi is not respected as support or resistance after being broken, that is sign of high volatility in the time frame. Every smooth Heiken Ashi trading strategy should include price action main rules. First, look for support and resistance levels. Second, look for chart patterns for potential breakouts. And third, try to enter into emerging trends and exit on slowing trends. Also, as you are able to see the classic candlesticks, you can combine classic price action with smooth Heiken Ashi. You will able to identify a pin bar, price gap, an engulfing candle or a reversal pattern, and at the same time, knowing what Heiken Ashi are indicating. With classic candlesticks, a bearish engulfing candlestick pattern at a smooth Heiken Ashi resistance level can be a nice starting signal, a decent entry into a beginning downward movement. Nevertheless, there is room for misinterpretation. With additional smooth Heiken Ashi candles on the same chart, you can mitigate this danger of misinterpretation and can help you to judge a trend more clearly in combination with classic candlesticks. That's why it's better to use both candle types on the same chart. Despite the simplicity of the Heiken Ashi approach, you must be aware that Heiken Ashi candles, unlike classic candlesticks, are in fact indicators. This is due to the construction of Heiken Ashi candles, in which the current and previous periods are always considered. So the Heiken Ashi candles are not the ultimate trading instrument. That's why the combination between classic candlesticks and Heiken Ashi represents a better and safer approach to trade. You analyze the markets on the classic candlestick chart, and you apply the smoothed Heiken Ashi to filter against false signals and background noises. As always, if you learned something new and found value, leave us a like to show your support, subscribe to our channel and hit the bell icon to stay notified when we upload new videos. See you next time.